Good evening and welcome to Mango Spaces. There have been a couple of questions being asked about Centum, so we decided to reach out to the CEO and bring him on Spaces so that he can answer as many of your questions as possible. James, it's been a while. Really nice to have you back again. I think we should do this a bit more often. I want to start with you. Maybe you can tell us a bit about how you're doing yourself and how your journey has been to Centum for those who don't know you, and tell us a little bit about Centum, and then we'll get started with a few more questions.
Good evening, Eric. Good evening. Thanks for logging in, and thanks, Mango Capital, for organizing this space event. It's really to have all of you online. I am James Moria, CEO of Centum. I've been with Centum for quite a while, since January 2009. It's been quite a journey. And it's true, we've not been on this spaces for a while, so it's a pleasure to be back and looking forward to a robust and engaging 1-hour conversation.
Maybe to start it easily, tell us a bit about yourself and your journey to Centum, and just a bit about Centum itself on a bird's eye view. What's Centum?
About myself, many of you may not know, I'm actually a lawyer by profession. I'm also an accountant. I joined Centum in 2001 as an intern. I was there for a while, eventually left briefly, came back and was appointed CEO in 2009. So I've been in that role since then. Centum is a listed investment company. It's a closed-end investment company. It's a bit interesting because just this evening I was reading an article in the FT about private equity funds that are now listed. So we probably started this trend a lot earlier. So primarily we invest in private capital, but we are a listed investment company. And we invest in a broad range of companies, and our goal is to grow the value of those companies and ultimately realize our return either through dividend, repayment of shareholder loans, or ultimately an exit.
So just walk us through the process of creating value for a company from starting to when do you start acquiring a company? What are you looking for in terms of criteria? And what's the value add that you do until the exit process? So I think of it in terms of what's the value proposition for Centum investment?
So we typically look at an opportunity and determine how can you create value in this opportunity and who are you creating value for. Typically there's a market, there's a need, there's a secular trend that you're backing, and it's sufficiently large opportunity that you can create value. You then have an investment thesis or a business model, and you may either acquire the company or we start the opportunity from scratch. It can either be a greenfield or an acquisition. An example of a greenfield is a decision to go into the special economic zones. Those are total greenfield ventures, and you get started. And when you're acquiring, you then do a valuation, you negotiate the acquisition price, and then you prepare as part of that process the due diligence. You do your post-implementation value creation plan, and you come in and start implementing it and see whether you're hitting the various metrics that you had expected. Depending on what the ultimate objective is, you may either exit or you remain a long-term buy and hold investor.
So some people get worried, especially when you exit companies. What's the thinking around that in terms of exiting a company? Some people complain that you're selling your crown jewels. But perhaps you can give context to what informs an exit generally, and then we'll come specifically to the portfolio soon.
Perhaps I can take a step back, because every investment depends on what mandate management has. So when I took over CEO of Centum, the mandate that I had from my board, and the way I saw myself is a partner with the board and the board as a client. So the question is, what is the mandate? And their mandate were following: grow the tangible assets. Before, the bulk of the assets were in listed equities. So they wanted a pivot towards non-listed securities. They wanted to scale up the balance sheet. Assets were about 4 billion in March 2009. Second objective then is, how do you finance that growth? That growth was to be financed using non-recourse debt, meaning without recourse to the shareholder and without any shareholder equity injection. And over the period, try and return our original capital so that we don't take too much risk, and also pay the acquisition debt in full. So given that objective, if you look at the 4 objectives, I'm coming to the exit conversation. So when we started, the assets of 4 billion, the objective was to scale. So we moved from 4 to about 50 billion. That's about 12x. The other objective was to grow the book value of shareholder funds. So that has moved from 4.1 to 45 billion. But then the other objective was the shareholders wanted their capital back. So the only way you can do that is through dividend, meaning when you exit, you then try and make some distributions. So the 4.1 billion, we've distributed 5.3 billion. Plus 100 million shillings of buyback. So you have 110% of the book value of shareholder funds distributed back to dividend. And the final objective was use debt, non-recourse to us, and then pay it in full. So we've done that. Now, because the shareholders have not put in any capital to acquire the assets, it follows that when you exit, first you must exit because you must repay the debt. And then when you exit, the sequence is that you first pay down the debt and then make distributions to shareholders. So over the last 5 or 6 years, we've had about 25 billion shillings of exits. Where has that money gone? That money has primarily gone to repay acquisition debt. So we've paid about 20 billion of acquisition debt. 2.5 billion shillings has gone back to shareholders as a reinvestment. So the exits are determined by the funding strategy you have. If you had funded the assets and the acquisition using equity, then one, you may not necessarily have to exit. And if you exit, then you can return a lot more of that capital back to shareholders. I hope, Eric, I didn't lose you.
No, I get that. And especially in terms of that bit about using debt, I think that's been the contention. You have been having a strategy of reducing that bit of debt. You can take that opportunity to give context to the fact that you've been really intent on reducing that bit of debt the past couple of years and how that's going.
So again, as I mentioned, the performance of a fund manager depends on the mandate you have. So our mandate was to scale the balance sheet using debt, not using equity, and to pay that debt down. We have, as of now, and we'll be announcing the full year results, at the Centum balance sheet, we've paid all the debt down. So we have no debt. So we've achieved that last goal of paying the acquisition debt in full. Had the mandate been a bit different, had we had the flexibility to raise equity, then that debt would have been paid off using an equity refinance, which was a debate we had at some point, but that was not the mandate we had. In that case, then you'd have had a very different holding period horizon. Perhaps some of the exits would not have been as necessary. So that's the point of explaining. But as far as the acquisition debt was concerned, and the reason it was necessary to pay it is not because you want to just to pay the debt, it's because for you to optimize the share price, you must pay the debt because equity investments are subordinated to debt. So when you have cash flow, the first use of cash is to repay debt. Then the residual is what goes to pay the shareholders. So if you want to optimize the share price, ultimately, for you to accelerate dividend payout, you must accelerate debt reduction. And that's already what you are doing, is trying to accelerate debt reduction so that you can then now deal with the share price and the shareholders can then enjoy the value. What is also important to explain, Eric, is that of the book value of shareholder funds of 4.1 billion that we had, you've paid back 5.3, meaning all the original capital is back to the shareholders. What that means that all the assets we have, about 45 billion or so, is all profit. If you look at it from the perspective of the individuals who invested originally. So we are now at a phase where I would call it a phase 3, where you're saying, how do I now harvest my profits, given that any further exits we do from here onwards don't have to go towards the debt service.
And I think one of the questions that you've received a bit is whether that debt has gone downstream of the businesses and the cost at which that debt have gone. So perhaps we can start by you giving a bit of how the group is structured, first of all, give us a flavor of the different components of the business, and then we dig in.
That's a good question. Because the objective was to scale the balance sheet using debt, it means that you must be in control of the cash flows of the underlying companies and also the timing of the exit decisions. Because you must be in control of that, you need to acquire control companies so that you're in control of the underlying cash flows. If you have that strategy or that objective and you acquire companies that you don't own more than 50%, then you can easily get stuck with illiquid minority positions. The consequence of acquiring companies where you own more than 50% is that they become your subsidiaries. When they become your subsidiaries, you now have to consolidate their financials as if you own 100%. Now, that's why when you look at the group consolidated financials of Centum post this particular strategy, it changed materially because prior to this, we primarily held minority positions, 25%, 30%, but as a 25% shareholder, you are not in control of the capital distribution policy of that company. So I was just explaining when shareholders speak about group financials and group debt, what they're really referring is a consolidation of the investments we have, which we have more than 50%. So I've just explained why we held more than 50%. Now, if you look at the group debt, i.e. the debt sitting also at the subsidiaries, it has gone down by about half. So in 2022, it was about 30 billion. It has reduced to about 17. But of this 17, some of that debt is from Centum to the underlying subsidiary companies. So in Centum, it may sit as an investment. In the subsidiary company, it may sit as a debt. So it is then disclosed as a debt in the group company. So if we exclude debt to subsidiary companies, which is from Centum, that has materially reduced. Now, what is important is the debt that is sitting in the entities where you want to upstream cash flows. Why is that important? If you are operating cash flows at that level and you have debt, those cash flows get stuck. So in our key assets where we can get cash up, especially our land assets, we've more or less paid all the debt there. So those are now debt free as of today, meaning when you sell those underlying assets, you don't have a debt trap in there. That is really what has happened. So the debt has materially reduced. We've not taken major debt apart from Triffic, which has taken working capital debt. And I want to make the distinction between working capital debt and acquisition debt. A lot of the debt we had here was acquisition debt. And the reason it was acquisition debt was because of the point I made earlier. The shareholders essentially indicated we don't have any money to put in. So you have to borrow to acquire the assets. So it follows that you have to use debt to acquire the assets, and then you have to get further debt to raise working capital. So the debt we now have in some of these entities is working capital debt rather than the original acquisition debt. The original acquisition debt has largely been paid back.
And working capital debt in this case is what they use day to day in terms of business, right?
Yeah, day to day you have, for example, say Triffic, we recently raised last year a mezzanine instrument from Advantage Capital in South Africa. That is to do fit out just for your working capital business. Now that is about $40 million. Because it's mezzanine, it is disclosed as debt, but it's non-recourse. Non-recourse means that there's no parent company guarantee. So that is critical because then the investor is really looking at the cash flows of that particular business. Now, the beauty of these working capital arrangements is that these particular investors put in 100% of the money, but they are only taking about 30% of the profits and you're keeping 70% of the profit. So as a fund manager, when you have those constraints, then you have to think very creatively. How do you then finance the underlying business of the portfolio companies? Given that you have these constraints now, you need to pay debt, you need to return the original shareholder capital, and you still need to fund the working capital requirements of the underlying businesses so that you can continue sweating those assets.
I'm now looking a bit at the group structure as of March 31st, 2025. Could you walk us through a bit the composition of the various aspects of the business, the portfolio itself? How is it looking like right now? So if someone is new to Centum, what are the key things that you want them to pay attention to when they're looking at this corporate structure?
I actually want to simplify that corporate structure. In simple terms, we have a portfolio of assets. And if I take our real estate portfolio, let me just take that as an example of how it was looking. And this time round, because of the questions, we'll also try and simplify this in the annual report. So if you take our real estate in simplification, we are holding it through two vehicles, through Two Rivers and Centum Re. So for Centum Re, we deployed 9.3 billion shillings of capital. So far, we've returned back 8.3 billion. So the net cost is about 940 million and it has a carrying value of 23 billion. Two Rivers, we deployed 11 billion. We've gotten back about 7. So net exposure is about 5, carrying value is 10. Now, then you have different assets, investments like Isuzu, NAS, same structure. We had Cydia in India, which we were down to 20%. And then we have a marketable securities portfolio. But that really is a simplification of how it is. Now, because of the requirements to create group accounts, that's what makes it appear complicated. But at its basic framework, that's how it looks like.
Is the portfolio tilted mostly towards still real estate as of now? And was that intentional?
That's a good question, Eric. If you look at the net investment into real estate, we deployed about 21 billion shillings in aggregate. And we have returned back about 15 billion. So about 73% of the capital is back. So the net investment is about 5.7 billion. So if you look at what we deployed into real estate, 5.7 billion net, it's actually about the same as what we had deployed into CDN, about 4.7. What has happened with real estate is that the values have increased significantly. So the 5.7 billion, the carrying value today is 34 billion shillings. So it's a positive thing because there's been a value uplift. If you look at it from cash deployed and cash back, it's actually been fairly successful because we got almost 3/4 of our capital back and we still retain a significant amount of the residual assets. So it's been a function of the return. Actually, I wish all the other assets are done as well.
So it wasn't intentional, so to speak. It's more like a portfolio grew. If you look at the financials of Berkshire, Apple grew to become a significant, mostly because of just the share price appreciating more than the others. So then you have this asset that becomes a huge part of the portfolio. But in that regard, then even the liquidity there, are you thinking deliberately or perhaps reducing that exposure at some point? What's your optimal portfolio looking like for you as CEO when you look at the entire business?
Well, actually, Eric, over the last 6 years, we've gotten 15.2 billion out of the real estate business. So we've been harvesting a lot of it. It's just that the returns were so high, it has been outsized. So from a return perspective, we've gotten almost as much out of real estate as we got back from our bottlers, because bottlers we got about 18 billion. Real estate so far we've gotten 15.2, and we have a lot more to harvest. But the idea when we got into real estate and places like Bipingo, what we wanted to create was a cash cow. The objective was once you finish paying the acquisition debt, you want to be left with as much land as you can, so that as a company, you then have a continuous source of cash flow investment. So for example, today we're able to sell an acre in Bipingo of industrial land at about 8 to 10 million shillings. And we have 4,000 acres of that. And another 2,000 acres, which is in the Bipingo Special Economic Zone, where we have 25%. And remember, we acquired 10,000 acres. So we've sold 4,000 acres and paid the acquisition debt and upstreamed quite a lot of capital and been left with 6,000 acres. Now we've put it into its highest value use. So the objective is, if say even in a year you just monetize 200 acres at 8 million shillings, that's about 1.6 billion shillings. You can do that for the next 20 years. And you don't need to raise any external capital. So that's the phase we are in. So if I break this into 3 phases, phase 1 was rapid growth of assets using debt. Phase 2 was pay down of this debt. You can only pay down debt as an investment company through 2 sources. Either you raise equity or you sell assets. So you try to sell the assets where you can get the highest value exit. That phase 2 is what has come to an end now. Now phase 3 is a monetization phase. And in that phase 3, you can then decide how much do you distribute to shareholders and how much do you reinvest. That's the phase we're in now, Eric. Well, that's the phase we've just gotten into.
So I want to go maybe through the various segments of the portfolio, and then you give us just a broad overview on how each is doing. So let's start with Two Rivers. Under it, you have Terrific Knolls, Terrific Twin Towers, Two Rivers Property Owners Limited. You can tell us a bit about how that's doing. Other whole, I think you're based there. So how is it going? How's the business progressing? Terrific is in the market for a high rate. How is that going? Tell us a bit about the rate and how it's doing. And just a bit of flavor in that when someone is looking at your portfolio.
So the idea here is when you start from a land, you want to go to its highest value use. And the highest value use when we did the research was if we could focus on supporting export-oriented enterprises. If you could use Two Rivers as a location to support export-oriented enterprises, because then you are addressing the global market. Now, to support export-oriented enterprises, we started working on it earlier, but it eventually happened in 2020, was gazetted as a special economic zone. So the special economic zone, the enterprises that are coming to operate there are enterprises that are operating in the global market. They're not necessarily enterprises serving the domestic environment. And the business model is to give them a bundled service where you then give them space, which comes with business support as a bundled product, and you charge your rent in hard currency, and you develop the asset, and eventually you exit it to an IREIT. So how is it doing? So we started off with an existing building, and it's about 16,000 square meters of space. Today we have about 30 enterprises operating there. As of this evening is around 95%, but the other 5% is booked. We've taken the second building, which was a building that was developed by Victoria. That is also almost 60% now booked. And we have a pipeline of about 600 enterprises. So the idea for Two Rivers is for it to end up being like a DIFC. Now, because it's a capital intense activity, then you need to exit through the IREIT. And we have funding partner for this line of business, which is the Vantage Capital. So we are working with them in this line of business. We have development potential of as much as 800,000 square meters. So the developments are fairly short term because once you develop, you fill it up. That cycle takes about 24 to 30 months. Fortunately, we did not have to start by putting up new buildings. We used the 2 existing buildings. So one we acquired from the mall and the other we've just leased long-term basis from Victoria, and we are now putting up the next building. The other major use is the residential node. That we have now quite a bit of demand. We are working closely with the Nedbank, who financed the acquisition, to finance the senior portion of the debt, and we've not had a challenge on sales there. So that is also progressing well. So the idea is to monetize the development rights by selling the end product through those two products. We started off as a 58% shareholder. We are now an 80% shareholder of the entire ecosystem. And our net investment there is 4.8 billion shillings. The IREIT is currently in the market. It has been well received by both institutional and high net worth investors. All will be closing in another few days. But the idea of the IREIT was to have a permanent infrastructure mechanism or permanent capital market infrastructure mechanism where you can exit completed facilities. And you can use that both to exit facilities in industrial and in commercial. So even in Vipingo Special Economic Zone, when you develop industrial facilities for clients, you can then exit them through that vehicle and then recycle the capital and then sell out the profit.
I wanted to move a little bit to Centum Green, and then you tell us a bit about how that's doing also before we move to the PE side and the marketable securities portfolio side. So tell us a bit about the Centum Green.
So Centum Green, my view, it has done well. If you just look at the numbers, we deployed 9.3 billion. We've been able to return back 8.3 billion. So a lot of our deleveraging has come from returns from Centum Re, the cash we've gotten back. But the reason it has not shown up through the P&L is because when we structured it, we structured these as shareholder loans. So when they are paid back, it is a principal repayment of a shareholder loan, which goes through the cash flow and the balance sheet. It will not cycle through the P&L. So to date, we've gotten 90% of our capital back. Our net original investment left in Centum Re is 947 million. I expect in another 3-4 months, we'll get this money back, which means we'll have gotten all our capital back. Now, what do we have left in Centum Re? We now have in Vipingo 4,000 acres, which we own 100%, and it's unencumbered. And the idea was to have an industrial anchor, which is why we managed to get another 2,000 acres gazetted as a special economic zone. Now, given the experience we've gone through and the constraints we had around ability to mobilize or constraints around mobilization of additional equity capital at Centum level, we brought in a partner who is going to be managing it, and not just managing it, but providing equity capital for investment of infrastructure within the Vipingo Special Economic Zone. So we have ended up with 25%, but it's 25% of fully funded 2,000 acres. Now, that was to create demand for the remaining 4,000 acres. The idea is not to monetize it in one go, is to develop it over time. We also have an excellent location now in Uganda. We are working on the tail end of getting it also part of it as a special economic zone. And the third part of the business is the housing development business. When we got into housing development, it was actually accidental. It was just to stimulate this site so that we could sell the requisite land at a higher valuation so that we could recover our capital. So the housing business achieved that purpose. It is now scaling, and we are spinning it off into a standalone vertical. Right now, it's embedded within the land business. So it will be a standalone vertical on its own, and that we should be able to scale that business. So that's where we are with Centum Re.
And then in terms of reading the cash flows of those two businesses, which are more oriented toward real estate portfolio, when someone is looking at their financials for the group as a whole and for the various companies, what would you guide them to be looking at in terms of how the business is doing? How can they know how much has been upstreamed and how much you've invested in? And how can they track those metrics? Because you seem to have a really good overview of that. How can that be now translated so that the investor can also be able to understand this bit?
Actually, we have a fairly detailed disclosure we put in the annual report and I think in the investor presentation of the consolidated cash flows, because now you need to take our profit, add back all the non-cash items, add back shareholder loan repayments, because from a capital structuring perspective, it made sense to structure these as shareholder loans and then add back disposals. We track that. So if you look at the last 5 years, we realize about 37 billion due from aggregate those sources. It largely went to pay down debt. Why? Because you have to return capital to its providers first before you can start sharing a profit. Now that is done. So that line, we don't expect it to be there from 2027 because that we've completed. What will be tracking now of our cash flows, what will be going into investment activities and what will be going to dividend payments.
Now, let's switch to the PE side. Tell us a bit about what the portfolio there looks like. There's been some exits. The annual report for 2025, we have the holdings that you have in there. There was CDN. Are you exited? What are the thinking around it? How's the portfolio mix looking like right now as you head into the full year 2026?
So why did we exit CDN? Our primary objective was to deleverage. Because of the reasons I've given you is that as long as you have debt on the balance sheet, it means that you're constrained in how much cash you can downstream to shareholders and even how much you can invest. CDN, we invested about 4.7 billion shillings. Initially, it was actually 2.5. Then we did foreign investments of 2.2. Because of the changes in the law and the growth in the balance sheet, there was a requirement for us to invest more capital. Would actually have been required to invest another 3 or 4 billion. So it would have taken us to almost 8.7 billion shillings. Now, that was not aligned with our objective as an organization. And that's why we took a decision in 2024 to exit CDN. Initially, the buyer we got was Access, who was only willing to buy 80% of it and to pay us 20% after 2 years, largely because we wanted to see how the book would trend. That did not work out well, so we got an alternative buyer on the same terms, 80-20, and the 20 was dependent on how the book performs. So the book actually did better than we got a 15% uplift over what would otherwise have gotten. Now, some people asked, why didn't you keep that last 10%? The challenge with being a small shareholder in a private entity is that those shares essentially become totally liquid and you can't exit and you have to follow on investment. So you are no longer in control of your destiny. So we have learned that lesson and we really don't want to hold small minorities in unlisted entities. It makes sense if you are a small minority in a listed entity, but not a small minority in an unlisted entity. So had we not sold this time around and there was further dilution, then no shareholder would have been interested in that stake. So that's why we fully exited the CDN. It was for that reason. It's a great institution. I think we are good at building great institutions, and that's what we've built. We now have Fudu, it's done very well, and it continues to do well. We have now about 60% market share. I saw some questions, are you thinking of exiting? At this point, because we have addressed the liability side, the asset liability mismatch, there's no real need or pressure to undertake any exits at this point. I think we are more or less done, unless that exit would significantly enhance the value of that company. For example, you're bringing another investor into the business. So for some of our businesses, there's scope for us to bring in other investors into the businesses because that may create considerable value. One of the portfolio companies we increased our shareholding last year was the Akira Geothermal. We had made a significant provision for it, but now there's a lot of interest in green energy. Before we were not in control, we are at 85% now. We just wanted to be in control so that we could crowd in another partner and get it moving. And our strategy is to do exactly that, where we have large stakes, try and bring in other partners and then scale up these businesses, because sometimes partners bring competencies that we may not necessarily have. As we continue receiving cash flows from our land holdings, because our housing development business is more or less fully funded from an equity perspective, those can be used to optimize existing portfolio. Part of it will be redistributed and part of it can be reinvested into new PE portfolio assets.
I hear you talk a lot about ownership and the percentage ownership and what you can do in terms of influence. What's an optimal holding position for you? When can you actually have influence in a bit of the direction of the business as a whole that you're owning?
When you go below 25%, you cannot block a special resolution. If you can't block a special resolution, you can't get a good price for your shares from the majority shareholder. You need to be able to either exercise influence or restrict the ability to make certain decisions for your shares to have some value. When you are above 50%, that's great. But the challenge is that sometimes you have a lot of responsibility. Now, initially, because of the mandate was scale up using debt and pay back, the easiest stake to sell is a control stake, because a control stake can be sold to a strategic. If you look at a lot of the exits we did was to strategic. Strategic means people in that business. For example, the bottlers, even as we were scaling up to 54%, we had an agreement with them that once we got 54% and achieved certain milestones, they were going to buy that stake. So that was an agreement we had reached almost 4 years earlier. And we were just working towards that mandate. So ideally, you want to get to control, but you don't want to go below a 25% threshold largely. If you're going to go below that, then you'd rather be in the listed space where you can sell at any time. If it's a great company that is paying you consistent dividends like Isuzu, great governance, then it doesn't matter because you're not really there to exit. The dividends make sense. It's a growing company. Then that makes sense. But if you're still scaling it up, you want to have a bit more control because of those capital allocation decisions.
One of the challenges that I've seen a few questions on, one of the portfolio companies was taking up debt at around 25%. Now, how do you respond to these investor concerns?
That's a very good question, and you've asked it. So what happens that
In TRDL, we only own 58%. So when you own 58% and the other shareholders are not putting in capital, and you're the one putting in capital, then you must price it at a level that compensates you for the equity return of capital. So a lot of that debt is actually from Centum. So we were providing that capital to TRDL at 25%, but on our end, we are not reflecting the full return. Now, why that is advantageous is that when you are now buying the assets from that particular entity, you are then converting your principal and accrued interest as part of the consideration for the assets. So unless you have a high rate of return, no one else will put in money. If you provide shareholder loan at 15%, that's fine if you own 100%. But if you own 58%, then you are transferring value to the 42% shareholder. So the 25% are largely shareholder loans. So if down the line we want to acquire more assets from PRDL, an entity that Centum controls 100%, then part of the acquisition price will be settled through an offset from those loans, which are continuing to accrue interest. It's just a structuring item to deal with that governance issue.
I have a couple more questions, and then we try and take a few more questions from the audience. One is around capital returns and capital allocation, especially returns to investors. I think some people are worried that there was a share buyback program that you had. I only achieved a small portion of it. So tell us a bit about your thinking around capital distribution, especially back to shareholders. I know they've been clear they didn't want to put in more capital in the past, and then you had to take up debt. So what's your thinking around returns to investors generally, as you think about just your capital allocation decisions?
The first goal was to increase the asset base of the company at minimal risk to the existing investor. And that's what we achieved. We grew the assets 12-fold and returned the original capital of the investors and also paid down the debt. A lot of companies get emotionally engaged with their assets when they are funded it using debt. You can't do that. If you do that, you'll run into problems because the assets will be sold for you. So you have to sell the assets yourself at a fully priced exit and allocate capital initially to pay down the debt. So then what you're left with is what is available for distribution and reinvestment.
Just to chip in, is that the two-edged sword that is debt, in the sense of like it can boost returns, but then again, if you end up with too much debt, it may also hurt you the other way?
Yeah, debt is great, but it's a bridge because you have an asset liability mismatch. So when you are funded equity, when the assets are equity assets, these are long-term assets. So if you funded the acquisition using debt, as a fund manager, you must repay this debt as quickly as possible because the issue is that the interest rate can compound at a faster rate than the growth of the assets. That's why we had to very aggressively pay down this debt. So we had a long debate in 2015, 2016, whether to raise equity or to sell assets. And the view that carried the day among the majority shareholders that they did not want to be diluted. So it meant that at that point, then the decision is that then you have to sell assets to pay down the debt. Now, once you pay down the debt, then the shareholders now come closer to the assets and they come closer to the cash flows. And it's only at that point that you can resolve this NAV to price mismatch. And that second step has to be taken. So some of the shareholders who are frustrated, so you have two classes of shareholders. The shareholders who were there originally, they've done very well because relative to what their share price was, they got all their money back and they have this embedded value. Now, if you came later, the challenge is that you came into an instrument that was structurally subordinated to this debt and your dividends are further out into the future and the discount rate is higher because of the uncertainty that comes with the balance sheet with the debt. And that's what we've been trying to resolve. And that's why in 2018, we announced that the primary focus would be debt reduction when it was clear that we were not going to be able to get to a point where we could raise equity. Now, that's a point we have cleared now. Now, once you clear that, now you have flexibility from a capital allocation perspective. You have flexibility now from exits. How much do you allocate towards dividend and how much do you allocate towards the reinvestment? Prior to that, you don't have that much flexibility because you have to retire this debt as quickly as possible.
Are you saying there are good days ahead for shareholders? That's what you're saying?
Yeah. It's just that this second phase is not a popular phase. And that's why many companies don't do it. Many companies struggle to deleverage because it's not popular when you're selling assets. So now that we are done with it, which was a critical phase, then there should be good days ahead for shareholders because if you look at what we exited, and I saw shareholders asking, where did the money go? 90% of the money went back to the providers of capital, and the providers of capital are lenders and shareholders. Actually, no, lenders primarily, because shareholders never put in any capital. So shareholders got some return, But now going forward, the residual assets, so all the assets we have are essentially profit with no underlying debt, which means if you realize any value there, that cash is available for distribution to shareholders. You're no longer structurally subordinated.
Could you address the share buyback, the program that you had in mind to boost the share price? And then also, as you discussed that, could you also discuss a little bit about the common issue? You talk about NAV a lot, the NAV of the portfolio, and it's pretty high compared to the share price currently. There's that disconnect, and I think that disillusions quite a bit of investors in the process about that. Also, if you put that together with the previous question that I had about the share buyback program, what are you thinking around it? Does it pain you as a CEO that the gap has not yet been crossed?
No, it doesn't pay me, and I'll explain why. Actually, a finance issue. I'll explain why shortly. On the share buyback, when we did the analysis, the issue was that it was a liquidity issue. So there were shareholders holding small lots would go to the market and not necessarily get a counterparty buyer. So the idea was that if you have a share buyback program, you can provide liquidity for some of these small lots. And because the eventual average share price is determined by the shares that are traded, if you have small shares trading like 100 shares, 200 shares, those shares end up setting the price for the company. Now, the CMA rules provide that the maximum share buyback price can only be 10% above the volume weighted price. So that price was capped. So when we went to implement the buyback, the shares that were actually available to be bought at that price were very few. And because the program is fixed, you cannot amend the price to increase it. But the program achieved its purpose, which was we really did not want to buy the shares from the shareholders cheaply. What we wanted to do is address the liquidity issue that was there. And once that was addressed, the shares ended up with the price discovery. Now, I want to come to the NAV and share price gap.
Look a bit, James, before you go there, I wanted you to reflect a little bit on the share buyback program. What would you do differently? A couple of companies have tried it and it's not been successful for some. What are your reflections around it and around maybe the regulators, something that they can think about in terms of making that process of share buyback a bit easier for you? Maybe
Eric, our real objective was not buy back the shares. It was to buy back the small shares that could not have a market. That was the objective, to mop up so that if I come to the market with 100 shares and nobody is buying that today, you provide that shareholder with some liquidity. And that was achieved a lot faster than we thought possible. And the price quickly appreciated, because if you bought all these shares at 9 shillings, you would have denied those shareholders the opportunity to realize value at a higher price, which ended up like 14 shillings. Which actually is almost a 50% increase. That was really the pain we were dealing with on behalf of our shareholders. The analysis suggested that we would have needed to buy many more shares than we ended up buying, and the price went above. So we've now applied for a renewal of the program, but the constraint is that the program is for 12 months and the price cap above the volume weighted is only 10%. So maybe what can be different, maybe is a wider cap, like 20 to 30%. But that would need an amendment of the regulation, because 10% for a market is too small. Shares move by a lot. Like where our share price is today relative to NAV, if it starts closing, it can move very significantly. And so 10% would be too small, because even if you do it at 14 shillings, it would be maybe a maximum of 15.5 or 16 shillings, and then you maxed out of the club. I hope I've answered that question. I wanted to go to the next question, which is a very important question.
yes, please.
This next question, the NAV and the shares, these are two different instruments. The NAV is the value of the underlying assets. But between the assets and the share, depending on the capital structure, if you have no debt in the balance sheet, it follows that the cash flows from the realization of the assets are all available to shareholders. So you're not subordinated. So when you're valuing the share price, it's a function of what cash flows are left after the parties with the prior claim on those cash flows have taken what is left, and that's what you discount. Now, when you have the capital structure we had before, it was natural that you're going to have this mismatch. And the way to resolve the mismatch is to remove that overhang of the debt so that you can bring the shareholders closer to the NAV. So that when the assets are realized or cash flows come from the assets, for example, in this particular case study of the exits, 80% of the exits have gone to debt retirement. That means the shareholders, their valuation is on 20%. That's what explains the gap. And the solution is what we've been doing. And remember, that is tied to the mandate. So it was clear. If the goal from the get-go was management focused on share price optimization, then the consequence that the capital structure had to change at that time, then the debt funded model would have worked temporarily and then raise equity, pay down the debt. That means then you don't have this 20 billion that went to debt would then have been available to go to shareholders. That automatically would have meant the share price would have been a lot higher. So the point I'm making is that the share price is a consequence of the capital structure. The capital structure is a consequence of the mandate. Now we've resolved that. So I'm expecting as we have more distributions to shareholders, you'll start seeing an narrowing on this share price. And that is what started happening as we reduce the debt. So as we continue to reduce the debt, you start seeing the price coming up because there was uncertainty as to whether we would successfully achieve the exits to be able to retire the debt fully, to be able to have cash flows available for shares. I hope I've answered that question.
Yes, I think so. The question I'll answer you, that bit, it was not pay you, it's about paying you that there is that gap between the share price. As a shareholder in the company yourself, do you feel that pain? Or do you share in the pain as the investor?
So when I bought my shares, for me, I bought as a long-term investor because I'm aware that as provided this is not addressed, we'll never really optimize. The share price cannot converge with NAV as long as you have that structural subordination. And that's what, as management and also as a shareholder, we've been aggressively trying to deal with. And so, although there have been a lot of competing interests for capital, for example, some people say reinvest more. We've had to cut reinvestments. We've obviously cut dividend temporarily. We've cut expenses so that we can deal with root issue quickly. But it's a positive thing in a sense because we achieved the primary objective. The primary objective was to increase the book value of the assets without any shareholder putting in capital. So just think about it. Somebody gives you a mandate and says, I want to grow my assets tenfold and I don't want to put in any money. And in fact, the money I have, I want it back. And the money you borrow, I don't want to guarantee and I want you to pay it back. Eric, that was the mandate. And actually, I want tangible assets. I even want long-term assets. So they're not saying I want to buy bonds. I want long-term assets. So that was the mandate.
A couple of questions here from the audience. One is around exits. Are there assets that you feel are ready or mature enough for exits? I know it may not preempt, but when you look at the portfolio and have a fear, are you in the mood for making acquisitions soon because you exited a few? What's your thinking around that currently?
It's a continuous exit we'll continue to do is selling down our land holdings. I think that is more optimal and that you can do continuously and that we are doing on an ongoing basis. And actually today, Eric, if we just sell 400 acres in Vipingo, you have 4 billion, almost the same amount of money you got from CDN. You have 3,600 left. So that's where the focus is. We don't need to sell any of our PE assets. There's really no appetite there. We may do partial exits, but not really for the exit purposes. It's more to maybe bring on board investors who we believe would help us accelerate the growth of these companies. But there's now really no need to. The exits were done for a reason. Actually, we built great assets. If we had raised equity, one would then have argued whether one should do the exits. The exits were done because of the liability profile, which you need to address. But where we are now, those are the kind of exits. You may do exits of your finished, completed buildings through the IREIT, but there's no large exits we are looking to do in the pipeline at this time.
You've been at Centum for close to 20-something years, 24-ish years, if I understand.
Yeah.
Some people are worried that you overstayed your welcome. What would you tell them in terms of succession planning?
No, I think the business is in a much less risky position now. So now one can discuss of possibility of succession because now it's more of a value optimization phase. The risks that were there before around how to manage all these complexities with different financial people, they're not as much. I enjoy the job, but maybe there are younger, more energetic people who can create a better value for us. So that is open. I'm a shareholder primarily, but I think it's a lot easier to have an exit conversation now given the stage where we are at the moment.
But you feel you have energy still?
Of course I have. I'm only 47. So it's that I started early, I'm only 47. Of course I do. You have experience, but you want to do the job to the end. You don't want to take on debt and then leave it hanging on the balance sheet. So for me, my job was to deliver on the mandate, which I think I leave it to you and the listeners to assess whether we did it well. But at least that phase has been done well. We are now getting into another phase. I just wanted to share the facts. I think the listeners can form their own views whether that has worked well.
Another question I wanted you to address directly is the issue of compensation. They feel like you extracted maximum value from the business. So what can you tell them?
Actually, I saw that. No, I don't know what to tell them. Look, I'm not an expert on compensation, but the way I always view it is when you compensate, say, an executive or a fund manager, what value do they create and what is comp as a percentage of value created? Look, my team said, look, it's been reported in social media you've been compensated 750 million. I've not done a calculation how much it is, but I was told it's 750. Well, let's assume that is true. So the question was, if you take that as a percentage of book value created, by the way, Eric, how much do you think is a reasonable percentage of compensation to value creation for an alternative asset manager?
I think I've seen 220 sometimes in terms of upside. I don't know. It just depends mostly on the board. I think the board guides.
So in this case, it's 1.6%. And if you take it as a percentage of market values, if you take the opening market value, dividend paid, share buyback around 7%. So executive compensation has been between 7% and 1.6% of value created. I think you can form a view whether the board got a good value, whether they negotiated a good deal, whether it was not a great deal, but that's what it is. So I leave you to judge, Eric, whether it was reasonable or not.
I think the average compensation is always 2% of asset, and in terms of value creation, less than 220. So big. I think if 1.6% sounds a bit in the ballpark of. One more question, which I also want you to address directly, which has been very vocal. I should say, by the way, you're one of the very few CEOs I've seen active on Twitter. Or you send me the tweets, you read everything. I think you're very online. That's something that is really admirable in terms of that. So I think what people may perhaps are wondering sometimes is, and I know these are your frustration points, sometimes you want to address the questions and sometimes you don't have the right format to do this. And I think we'll do this a bit more often. We've agreed on that. Sometimes people wonder, like, where do we get more information on Centum? Where is there limited visibility on timelines, capital allocation decisions, the route from NAV to cash realization and all these? What do you promise at least to do differently going forward? And where can people get information about this? Can they come to Two Rivers and see exactly what you're up to? Can they go to Vipingo and see what you're up to over there? Is it something that they can reach out to you and you're able to guide in terms of your investor, come and see the things that you're doing? And are you holding perhaps an investor day in the near future? And perhaps that's something that we can definitely try to organize, where we have an investor day and people come and see some of these things. We moved online a bit too much. So I feel like sometimes people get disassociated from that you actually do own real assets out there. And because I have been to some of these places that you are invested in and just to see them myself. So could you address that in terms of the visibility in the portfolio and what you're planning to do about that?
First, anyone who asks me a question directly online, I try and respond almost immediately. So if you have any question, tag me and I'll try and respond. I remember when I saw these questions, I reached out to Eric and I said, I always like it when people have questions on Centum, because then if you convene a spaces, they have done a good job of convening an audience. So I didn't want to let this opportunity pass. So I actually pushed Eric for these spaces. But we do the investor briefing and we do a very comprehensive hack, which is available on our IR website. We do this every 6 months, a very comprehensive presentation. So actually all this information has been there. But look, I always feel that you can never over-communicate. So whenever investors have a question, people are coming from different places, I always feel it's our responsibility collectively as a company to try and communicate to them, share what we're doing or what we're working on. So perhaps we can do more, but we do these investor presentations every 6 months. We provide a lot of detail. Some of these detail are hard tasks when we are negotiating exits, because when somebody knows how much you are carrying it at, it becomes very difficult when you're negotiating an exit with them. I remember one time I went for a negotiation and somebody produced the annual report and said, you're carrying it at this value. Why are you asking for this price? And yet you're trying to get maximum value for your shareholders. So sometimes you're also trying to balance how much you disclose because of how it affects you. But you're always available, Eric, and I'm always open to ideas on what more we can do to enhance communication.
I will personally hold you to account on that. But anyway, anyone who asks questions, if they do forward them to us, we always do forward them to you as quickly as possible, because I think it will be in the best interest of everyone so that people know what's happening in the company.
I always respond. Correct, Eric?
Yes, you do. So let's go to a few of the questions that have been sent in by investors. So I'm reading some of them, so you can just respond and it's more of a quick round. So someone is asking how Longhorn Publishers is doing. Could you give us a state of Longhorn Publishers?
The Longhorn Publishers, as you've all seen, it's a listed company. It has struggled with the change in the CBC curriculum. There's been improvement with the change of CEO that came recently. I was looking at the numbers recently. I think the revenue is up 50%. Where they're doing a lot of work is on the digital education platform. The competitive advantage they have is that they have the entire curriculum and all the materials from the lowest grade to the highest grade. So they may be more of a pivot towards edtech and digital. But with the changing curriculum, that was a pivot that has challenged them in terms of their traditional business of selling to government. A lot more publishers got into the space and there were a lot of changes. So that's where Longman is.
The next question is about the terrific green I rates. It closes next week on Friday. Just give people a bit of a value prop on why they should invest on that.
The terrific green I rate is really a securitization of the cash flows of the enterprises that are exporting services. Kenya has a balance of payment surplus on export of services. What we need to do is to create a more enabling environment for exporters of services to come and locate in Kenya. The advantage of Kenya is that it's a much lower cost location. And these companies are operating in the global environment. The advantage for us is that they create a lot of jobs very quickly. If you book a tour of Traffic North Tower, you'll be surprised by the number of young people who are employed there. So besides the return, you're actually doing good because the biggest challenge we have now is youth unemployment. And a lot of the young people coming out of school today are not geared to be in manufacturing jobs. They're actually in services jobs. And therefore, we're essentially giving them an outlet into the international market by reducing the barriers to entry because we're taking out a lot of the capital intensity out of it. So it's an attractive return. Facilities themselves are edge certified. There's diversification. The anchor tenant there has 10 billion euros of global revenue. They're the largest. If they were in Kenya, they would be one of the largest companies. It's a great platform. And as it scales up, we'll be able to enable more companies to set up in this country by reducing the barriers to entry.
Another quick question. Now that debt has been repaid, what's your strategy going forward? And then are you looking for acquisitions? Any target sectors, industries? I think that's what Wambugu is asking.
I think Wambugu, our balance sheet, the assets have a lot of optimization opportunities. We can do a lot with the assets we have. It's just that we had a single-minded focus on reducing debt. You can't have too many goals. My belief is that you must have a single-minded goal and focus on it. For us, this was a critical goal, and we do not want to divert capital. Now that we've done it, we can go back and see what are the optimization opportunities within our portfolio. I don't think it makes sense to acquire new assets if you can optimize the assets you have to do a lot better. If you think about even this traffic rate, we didn't even have to put up a building. We're just using our existing building. So we have a lot of assets with a lot of potential. I think that would be the next phase. We are going to go an optimization phase. I would like, and we would all like to raise a dividend to the shareholders. So we want to allocate a bit more towards the dividend and optimization of the existing assets as a starting point. Once those are optimized, then one can think of new acquisitions because new acquisitions come with their own risk parameters. It's not easy. And if you look at the track record of many PE managers, they have not been able to exit. It's very hard. People take it for granted that you can invest, add value and exit. It's extremely difficult. And if you speak to many fund managers who've invested in private equity in this market, they'll tell you that a lot of funds are stranded with assets nationally and globally. It's a very challenging process. So one has to be quite careful around that.
Yes, I think globally it's a bit of a big issue. By the way, do you not invest in the tech sector? I think it's a budding one in terms of AI and stuff like that. Is that something that you're interested in?
So within the traffic, there's so many tech companies there. And so you really have a derivative. And now you don't have to wait to be paid on bottom line on P. You're getting your money at cost. So after they pay salaries, they have to pay you contractually. I would rather that and just facilitate them than have to understand all these different companies and cycles and things like that. Yeah, you are totally diversified. Many of these companies are in the tech space.
That's true. Another quick one. I don't understand the question entirely, but NAV Capital, how is it doing generally in your asset management side? You could also pitch a bit of some of this investment. So tell us a bit NAV Capital. And then someone was also asking how sales of units as Two Rivers are going and how the sales of housing in Vipingo is going. Those three.
I can see buyers here, but I think because of time, the hassle will be too much. I can see the CEO of NAV Capital. I think he's doing well. He's just gotten license for special fund.
A couple of funds that he got, the special funds should be answered.
Can you speak to him privately? I've really been much more and scale up. Yes? I think the sales of the units are going well. So, Eric, the primary reason why even we got into the development space was to catalyze the sale of land, and I think Ken did a good job on that. We have actually more demand than we had supply. We have gotten very good capital partners now for the development of these different projects. And Ken, who should be on the call, should be scaling up his business. Actually, I spent my Madaraka day with them, just going through their plan for the year. So we don't have a sales issue. Actually, what we've had more is speed of delivery issue. Everything in Two Rivers is sold, or most of it is sold. So what is not sold is what we are bringing up in phase 2.
We've exhausted all the questions that I have. I don't see any questions. And if there is any, please just send them to our email, hello@mongocapital.com. We'll definitely forward them to him, and then he'll be able to respond. My final question is now about where you are and given where you've come from. If you have this conversation in a couple of months, what are some of the specific outcomes that you're committed to working on? What does your day look like as a CEO in terms of actualizing some of this going forward? So you have an elevator pitch in terms of helping us understand why people should come along this journey also.
So our focus is to make our assets really make sense for the economy. We've done that in Traffic in terms of not just it being a real estate play, but an asset and a business that can really create a difference in the life of people and make financial sense. And I think Brent and her team have done an incredible job at Traffic. What they have achieved in less than 24 months is nothing short of incredible. And looking to scaling that. In Vipingo again is making it an industrial ecosystem. It's not just a land play, it's how do we create an industrial hub. It is probably the single largest contiguous parcel of land at the coast. And we were blessed and honored when the president gazetted 2,000 acres as a special economic zone. So as global companies look to locate the enterprises here, what can we do with that asset so that it's not the return is there and we get the return, but how do we make them strategic assets? And now that we've achieved our objective, which was to have strategic assets, which we did not have before when we started this journey. It has taken a long time. It has taken 15 years to get here. But now we have really quality assets. I think the critical thing is also what we're going to do with the power asset. It's a really critical asset. There's significant electrification of the economy that is happening. If you think about EVs and the rest, the demand of power is going to be very significant. The demand of power for industries is going to be very significant. The power wheeling regulations are now in place, so you can get your power from Akira to this location. Next week, I'll be at the World Geothermal Conference just trying to see how we can get that geothermal project moving. Because once you integrate it and you have a location where you can supply both power and facilities that can be offloaded into an IREIT, then it's really powerful. Now the housing makes sense because housing is for workers. So that's what we're integrating. And then now NABO acting as an IREIT manager. We are doing the same thing in Palmarin in Uganda, where you even have lower labor costs and higher rentals than Kenya, creating an SEZ there. And for me, really, as a CEO, I'm focusing on these strategic decisions because what time gives you is networks, global networks, which I have now to put this thing together. So it's not just a corporate finance activity. It is now how do you integrate this thing with experience to do it in a way that doesn't expose the balance sheet of Centum. And that's what we've been doing.
Well, why should investors join you? And then as you close, also share a little bit of what you've been reading recently and your just reflections on leadership and what you can tell the younger generation that is coming up, given what you know now and when you started Centum.
I've been through a journey. Many people don't stay long enough to see a cycle. And that's why I was also looking forward to this session because I can share things that people have read in books about asset liability mismatches, how to finance, mandates. And I'm always welcome to share as much information. There's really nothing mysterious about me. If you have any question, just send it to Mongo and I will try and respond and help because I've seen cycles. I was very fortunate that I started early. So we've seen all these different cycles. So I'm reading this book by Ray Dalio about the changing world order. It's a really interesting book because it explains what is happening globally now with the shift of the global supply chain from the east to different locations and thinking then how do we position our assets? Because we have assets now that are at a national scale. What we can offer is a national scale asset and how we can position ourselves appropriately to host industries and whether in advanced services or industry here. Why should you come in? You're coming in at the ground floor now. The price is the price of a share with debt. But now the company itself doesn't have debt. Talking about group debt, what I think, if they want, we can sit with them and just explain how that's working. At least where we can get cash flow now, there's no debt. So there's a significant discount. If I had more money, I would buy a lot more shares than I hold today. And it's probably going to be a very important company into the future. The assets we've sold, we can recover them. The key thing is to have the company alive, and then you can always recover them again. With the cash flows we can generate, you can always recover these assets again.
Parting shots?
No, mine is to thank everybody on the call. Thank you very much. Thank even the critics who criticize us, criticize the decisions. That's very important. We are a public company. That's always my view. I should be able to explain the decisions, why we took them. We should be able to be held accountable. We should be able to be asked difficult questions and respond to them. So it's great to have an engaged team, and I want to really thank everybody who is on this call and wish you all the best and encourage you, if you have some change left, please participate in the terrific IRIT. And if you have questions, please engage with Eric. If you have opportunities that can benefit by being in part of our ecosystem, you're most welcome to engage with us. I have members of my team here. They'd be happy to engage with you.
Thank you so much. By the way, James, the next earnings, when should people expect that?
End of next month, July, because 26th when we did all this, so July.
That's FY25.
And I'll try focus more on the cash flow, because this accounting things are very confusing. The standards are always changing, so we'll try and simplify it a lot so that just people see where we are on cash flows and where they are, what's the path towards getting their dividend.
We've booked you for that. We'll definitely host you for the speech immediately after the FY results so that you can give people a bit of perspective and hold a copy of the financials as you take us through them step by step. Is that not?
I'd be very happy to do that, Eric.
Once again, thanks, James. I should say that you're one of the very few CEOs who we forward all questions and you answer all questions, especially from investors. And you always also forward yourself some of the questions that you get online. And if you're tagged, you always respond. Keep that up in terms of being a standard in terms of engagement with investors. There's no need to shy away. If things are going bad, or you talk to investors. If things are going good, you still talk to investors. That's a positive that I think we've learned a lot in the process. So to the audience, if you have any more questions, please send them to us. Thank you for joining us. Thank you, James, for the 1.5 hours. I appreciate the time, and I can see your team in the audience. So thank you for bringing your team too. Thank you, James.
Thank you very much. Good night. God bless all of you. Thank you very much. It's been a pleasure to engage with you. Thank you very much, Eric, for all your questions and for your enthusiasm.